Institutional leaders rely on forward guidance to keep markets from panicking. By explicitly communicating future plans, they telegraph their moves well in advance. Trillions of dollars across the globe depend on this exact transparency. Investors price assets, manage risk, and allocate capital based on understanding the roadmap. But over the past few weeks, that roadmap disappeared simultaneously across two critical sectors: the United States Federal Reserve and big tech's artificial intelligence build-out. The immediate result was chaos. The bond market experienced a massive steepening of the yield curve, and a brutal tech stock sell-off pulled the Nasdaq 100 down 10% from its peak. While macroeconomic monetary policy and physical AI infrastructure operate in different spheres, the severe market reactions share the exact same trigger. Investors are punishing a lack of clarity. At the recent Federal Open Market Committee meeting, the central bank left rates completely unchanged. The official printed statement was brief and essentially identical to their previous release in June. This timeline plots the number of times 3 regional Fed governors have actively dissented against the committee's decision. This has only happened 6 times in the last 30 years. These 3 governors voted to hike rates, sending a distinctly aggressive signal about inflation. Instead of using his press conference to explain his highly unusual internal division, Chairman Kevin Warsh ducked questions about future intentions. He offered zero dot plots or economic projections, completely withdrawing forward guidance. Dr. Hastings Banda, the president of Malawi, famously gave a BBC interview where he answered nearly every question by repeating, "I won't tell you that." Warsh's opaque performance adopted the exact same approach. Look at this chart tracking Treasury yields. The 2-year yield plummeted as short-term traders thought he favored low rates. But the 30-year yield spiked to a 2007 high. Long-term traders concluded keeping rates steady was a mistake, unleashing inflation. Warsh attempted to make monetary policy boring by withholding information. By removing the guidance the market relies on, he turned a standard hold on interest rates into an expensive crisis of confidence. Across the country, big tech investors are applying the exact same demand for proof to the industry's massive capital expenditures. Every dollar spent on artificial intelligence infrastructure relies on a simple economic assumption. Tech giants are spending billions on capacity, believing the demand for computing power will accelerate infinitely. This chart compares Capex against returns. Microsoft cut capital spending to $175 billion, while Azure revenue leaped 43%, surging their stock. Conversely, Meta raised its Capex forecast while free cash flow plunged to $784 million, a 4-year low. Asking investors for blind faith while cash reserves shrink carries an immediate penalty. Following this release, Meta's shares dropped by 10% in after-hours trading. The industry is facing a math problem. If efficiency gains or slower enterprise adoption cause demand to plateau, these companies will be holding a massive glut of expensive, rapidly depreciating infrastructure. The macroeconomy has entered a show-me market. Operating on autopilot, assuming investors will give leadership the benefit of the doubt, no longer works. Financial markets historically test new central bank chairs, and those tests usually expose communication blunders. Alan Greenspan famously relied on speaking opaquely to navigate these tests. Ben Bernanke had to learn the hard way that even casual, off-the-record complaints to journalists carry massive weight and dictate trading behavior. By refusing to explain why he held rates steady in the face of elevated inflation and internal dissent, Warsh has painted himself into a corner. To prove his hawkish credibility and quiet the long-term bond panic, he will likely be forced to hike rates at the next meeting. The hyperscalers are caught in a similar trap. They can no longer point to future computing demand to justify their budgets. Every future dollar of AI infrastructure spending must now be backed by immediate, demonstrable financial returns, or they face severe market devaluation. Whether managing the federal funds rate or building server farms, the rule is the same. When leaders remove the roadmap, they break market trust and invite volatility. Finally, a brief note. The financial community recently lost Jim Levis, founder of the Bond Vigilantes bloc, at the age of 55. He built his career providing exactly the kind of clear, unsparing truth the market is currently starving for. Rest in peace, Jim.